How to become a smart investor. Is investing just about buying stocks and waiting for their prices to rise? Is success in the stock market based on luck and predictions? The truth is that successful investing is not about gambling or making random guesses. It is about having a smart mindset, patience, and careful analysis. In his legendary book, The Intelligent Investor, Benjamin Graham lays out the fundamental principles of investing and teaches us how to navigate the market with intelligence and professionalism, without falling victim to emotions or short-term fluctuations. This book was the foundation for Warren Buffett, one of the greatest investors in history, who called it the best book on investing ever written. In this video, we will provide you with a detailed breakdown of the key principles and strategies that can help you build real wealth through intelligent investing. Each principle here can completely change your perspective on the market and help you make more informed and strategic financial decisions. Let's dive in. Principle 1. The difference between a smart investor and an emotional speculator. Before you start investing, you need to understand the difference between two types of people in the market. 1. The speculator, someone who seeks quick profits, relies on rumors and hype, and is driven by emotions, fear, and greed. They enter the market hoping to hit a jackpot through luck, but often lose their money due to impulsive decisions. 2. The intelligent investor, someone who focuses on the real value of assets and invests for the long term. They don't care about daily fluctuations, but rather focus on logical analysis and choosing strong companies that are worth investing in. The question is, which one do you want to be? If you're looking to build real wealth, the speculative path won't take you there, but the path of intelligent investing will lead you to lasting success. Principle 2. The concept of margin of safety. How to protect your investments. One of the biggest mistakes investors make is buying stocks based solely on their current prices without considering their real value. Benjamin Graham introduced a powerful concept called margin of safety, which is simply the gap between a stock's market price and its actual intrinsic value. Small blue diamond, how can you use this principle to your advantage? Don't buy a stock if its market price is too close to its fair value. Look for stocks that are being traded significantly below their intrinsic value. This difference acts as a safety net that protects you from unexpected downturns in the market. Imagine you want to buy a used car and you know its real value is $20,000, but you find it listed for $14,000. That's a bargain. The same idea applies to the stock market. When you find strong companies trading below their real value, you found a golden opportunity. Principle 3. Emotions are the investor's worst enemy. Warren Buffett once said, "Be fearful when others are greedy, and be greedy when others are fearful." Why? Because the market is driven by two dominant emotions. 1. Fear. When markets crash, people panic and sell their stocks, causing prices to drop even further. 2. Greed. When markets rise, people rush to buy without thinking, causing prices to inflate and form bubbles. The intelligent investor does not get carried away by these emotions, but rather uses these fluctuations to their advantage. Small blue diamond, when the market crashes and panic spreads, a smart investor sees an opportunity to buy at discounted prices. Small blue diamond, when everyone is overly optimistic and driving prices to extreme highs, the smart investor knows it may be time to sell or hold back. Golden rule. Control your emotions and never make investment decisions based on fear or greed. Principle 4. The dollar cost averaging strategy. One of the best investment strategies recommended by Graham is dollar cost averaging, DCA. Wide heavy checkmark. The concept is simple yet incredibly effective. Instead of investing all your money at once, invest a fixed amount at regular intervals, monthly. For example, regardless of market conditions. Small blue diamond, why is this strategy effective? It protects you from buying stocks at overly high prices. It ensures you get a good average price over time. It prevents the stress of trying to time the market, which is nearly impossible to do. Practical example: if you plan to invest $12,000, instead of investing it all at once, you invest $1,000 each month for a year. This way, you buy stocks at different price points, reducing risks and improving long-term returns. Principle 5. Fundamental analysis is the key to success. Do you rely on YouTube and social media recommendations when choosing stocks? If so, you need to stop immediately. An intelligent investor doesn't depend on random tips, but performs fundamental analysis before making any investment decision. Magnifying glass tilted left: key factors to analyze. Earnings and revenue. Is the company generating stable and growing profits? Debt levels. Is the company heavily indebted, or does it have manageable liabilities? Competitive advantage. Does the company have something that sets it apart from competitors? If you're investing without studying these factors, you're not investing, you're gambling with your money. Principle 6. Don't try to time the market, because you won't succeed. Many investors spend a lot of time trying to predict when prices will rise or fall. But the truth is, no one can predict the market accurately. Rocket solution? Instead of attempting to time the market, focus on long-term investing in strong companies and don't worry about short-term fluctuations. Pushpin, one of Graham's best lessons. Time in the market is more important than timing the market. The earlier you start investing and keep your money in the market for a longer period, the greater your chances of achieving massive returns in the long run. Conclusion: how can you become an intelligent investor? White heavy checkmark: invest based on real value, not speculation. White heavy checkmark: control your emotions and don't make decisions driven by fear or greed. White heavy checkmark: use the dollar cost averaging strategy to protect your investments from volatility. White heavy checkmark: conduct fundamental analysis before buying any stock. White heavy checkmark: stop trying to time the market. Instead, be patient and let your investments grow over time. Direct hit: if you found this video valuable, don't forget to hit the like button and subscribe to the channel to stay updated with more investment secrets. Loudspeaker: share this video with your friends. It might be the first step towards their financial freedom. Thank you, and see you in the next video.